This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week, Wednesday morning, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, as always, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning. It's a tough day, right? It's a tough last couple of days for the market, given what's happening across the globe. And tonight, I mean, today looks like it's going to be no different. Already waiting for the day to end.
Well, indeed. And, if you're struggling with the week, then just 3 more days, and then we're off to a long weekend. So,
Monday.
Second.
Gandhi Jayanti, right?
Gandhi Jayanti. So,
and kids have a longer weekend, right? They have
they have tomorrow holiday as well.
From Thursday onwards. So it's going to be action-packed.
Absolutely.
But action-packed for the Bears.
Yeah, I mean, in the wrong direction, in the wrong way. So, let's just quickly tell you what you need to know. You got yesterday, which was very quiet, extremely quiet. And actually, you take it with both hands because globally, it's not been quiet, it's been ugly. So, the Nifty and the Bank Nifty both traded within the previous day's range. So Tuesday's sort of candle, high to low, was well within the sort of high and low of Monday. It's called an inside day. It basically indicates indecision, tightening of range, and just basically a lackluster kind of session or time. Now, kind of continuing with that, a global pullback seems to be underway, seems to be starting. And India, I would say, has so far avoided the worst of it. And the numbers kind of bear this out. If you look at, from the highs on the S&P 500, we basically have a 7% knock. On the NASDAQ, we have nearly a 10% knock. The Nifty, from its highs, is just down about 3% or so. And I'm comparing this market, the Nifty to the US and not other emerging markets, etc. Because, if you look at correlations, that's been the most strong correlation. These have been the strongest markets for the last 3 years. Actually, the only inclusion in the top performing markets in 2023 has been Japan. So India, US, and this year Japan as well. So while the US market is down on the NASDAQ by 10%, we are down, just under 3% or so. Now, overnight, you have negative cues. The equity market sold off 1.5% of the S&P. The NASDAQ was down about 1.6%. The WIX is rallying. The fear gauge, the CBOE WIX is now basically above the August highs. It's 19 plus, and it indicates fear in the market. Some would say with a 9.5% fall, there is extreme fear in the US, but extreme fear also kind of indicates a bit of a bottom. We'll find out. But anyway, WIX is indicating that perhaps there are more equity losses to come in the US at least. Technically also, all three indices, the Dow, the NASDAQ and the S&P have broken important levels, which kind of, project further downsides. And we can talk more about that later. US 10-year is holding at about 4.55%. The question is, 4.5%, actually 4.55 exactly is the resistance as well. So will it break above this, or will we see a bit of a pullback from here? Dollar index, now that's a big one, which is now past 106, right? 106.17. The impact, of course, is being seen here on the rupee as well, which is depreciated for 2 days in a row, well past 83. Nothing disorderly, but there is pressure across most emerging market currencies. Oil prices, they continue to move higher. We are past $94 a barrel on oil as well. So, the trioca, right? Yields, dollar and oil, they continue to move in a direction which perhaps is painful for markets like our own. Although so far, as I said, we've avoided the worst of it. For the Nifty, just to kind of get to levels, they remain unchanged from what I put out yesterday morning. The Nifty sort of support will come in at 19,605. The low which was made was exactly that on Monday. 19,601 was the low. That level is a 61.8% retracement of the move that we saw from the end of August to the highs of September. So that's the support. That's not very far away. And looking at the global color, my sense is you perhaps will see a break of it sooner rather than later, unless things start to reverse very quickly globally. Near-term resistance, and the very very, very near-term, is 19,734. 19,734. For the Bank Nifty, the recent low of 44,400 should act as a support, and the resistance comes in around the 20-day moving average, which is pretty much 44,988 or so. That's the resistance. Again, very near-term levels is what we are talking about. But we're doing that because the range here over the last 2 days has been so tight, and it's generally been very, very quiet in the Nifty and the Bank Nifty. You get another day like that, I mean, I think that will be an extremely good outcome given where global cues are at this point in time. Sonia.
Oh, absolutely. And, the gift Nifty is indicating that the start will be about 50 points lower, right?
Yeah.
So the Nifty is already trading around that 50-day moving average. Looks like we're going to breach that on the downside as well. It's not looking good. So it's advantage bears as we begin trade today. And if you map, it's definitely a sell-on rally market for the last fortnight or so. And if you map the trajectory of the Nifty has lost almost 2% in just 5 trading days. So that's the kind of damage that we've seen. In the US markets, as Prashant was also mentioning, steep losses is what we saw overnight, led largely by technology stocks. So the Nasdaq is down over 200 points in just one single day. Of course, you have foreign selling that continues in our own markets as well. So FIs have now sold almost 22,000 crores in September so far. Lots of money getting pulled out. It's the US macro data that was on the weaker side, and of course fears of higher rates in future. But whether it's the new home sales data, which fell about 7% month on month, whether it's the consumer confidence index, that fell to 103 in September versus almost 109 in August. So the macro data has been weak. Tech stocks have been under pressure. And 2 more headwinds. The dollar has hit a 10-month high as US yields have spiked. And Brent crude is now at $95 a barrel. So, there are a lot of headwinds on the sidelines, which is, of course, putting pressure on our own markets. In fact, in the month of September so far, that song holds true, right? Wake me up when September ends. I'm sure the bulls are waiting for the month to end. Just look at that. Nasdaq down 7%, S&P 500 down 5%, and Dow down about 3% odd. So let's see. We have a few more days left for the month to end, but it's largely, I think, tech-driven in the US markets overnight. So maybe in our own markets as well, you could see some pressure there.
Well, and yesterday, the final hour of trade, the problem was that, in fact, the Nifty Financial Services Index that played out expiry. So that's why at around 230 odd, you did see the Nifty Financial Services that did dip. And even you have the Nifty. Yeah, that chart is telling you the picture out. Then towards the end, it saw a bit of a recovery. Now, yes, we need to take on board that crude oil prices, the dollar index, they're quite uncomfortable at these current levels. With the dollar index at around 106 odd, not too good. And you have even crude at around $94 per barrel. But there are a couple of positives. So just want to pull that up. Now, yesterday, if you look at it, the Nifty ended lower. But you did have the small cap index that was a relative outperformer. So that managed to eke out some gains. So you need to be stock specific. There are plenty of stocks that are still doing well, even if the Nifty corrects a little bit or consolidates. So that's one point. Second factor is, after quite a few sessions, the Nifty didn't make a lower low. So, we have been seeing that the lows have been coming down. But yesterday, in fact, we didn't make a lower low. So that's encouraging as well from my perspective. What are the FIs doing? Well, they unwound some long positions and some marginal shorts as well. So in the last few days, if you compare, say, September 15th, with what FI positioning is as of now, they were net long, close to around 60,000 contracts on the long side. Now they're net short with close to around 7,000 contracts on the short side. So that's telling you a swing of close to around 70,000 contracts. From being net long, they're marginally net short now. And the short positioning as well has gone up to around 50% odd. Look out for some good news. Hopefully it comes from somewhere. That's what could give some kind of legs in case this market needs to bounce, say, 100, 200 points or thereabouts, which as of now, we haven't really seen. The options data, 19,650, 19,700 call. Well, both of them were fairly active, and both those premiums were at around 70 rupees. It came down to around 50 rupees, which brings us to the levels. The broad range I'll say on the downside is 19,600. That's where the recent low is. While on the upside, 19,770. I say that because there is call writing at around 19,700 call. You have the 20 as well as the 50 DMA. Those are the crucial technical levels as well. But that's the broad range you're looking at. A Nifty Bank, that plays out expiry today. And the recent low, 44,400, you wanted to hold that level on a closing basis. On the upside, the 20 as well as 50 DMA comes in closer to around the 45,000 odd mark. The GIFT Nifty again starts in that slot. As I said yesterday, it didn't make a lower low. You'll want the Nifty to defend the 19,600 odd mark. And with the market's net short, you're looking out for some bit of good news. So today is a crucial session. Keep an eye out on the Nifty Bank. And maybe, in fact, if you have that appetite with 19,550 odd as a stop loss, maybe you could look to buy the dip.
All right, look to buy the dip. Let's see if that plays out. For now, at least the market is under pressure or has been under pressure for the last few days, and looks like that could be the case going forward as well. On the equities front, though, we have a comment coming in from Chetan Seth of Nomura, and it's very interesting because he's quite bullish on the Indian markets. He says the structural story of India is now well known as a major beneficiary of the China Plus One theme, possessing a large liquid equity market. He sees recent softness driven by higher oil prices as an opportunity to raise exposure. He says while this weakness may persist in the near term, presenting even better timing, he thinks the window of opportunity might not be open for too long. Chetan adds valuation is expensive but will likely remain so in a scenario of policy government continuity. He says intense politicking into May 2024 elections, China re-rotation and sustained high oil prices are potential risks.
Okay, so money market views now. Abhishek Goenka of IFA Global says dollar seems on course to end stronger for the 11 straight weeks. He says the upward revisions in US Fed's 2024 median dot plot has propelled US yields to multi-year highs. Yuan continues to remain weak and crude prices still elevated, and all these factors combined are keeping the rupee under pressure. Expects rupee to remain under pressure and trade in a range of between 82.4 to 83.7 to the dollar over the coming few weeks.
All right, and on the bonds, Neeraj Gambhir of Axis Bank says after the much-awaited index inclusion news, bond yields initially fell but rose subsequently on profit booking. He says weaker auction demand and higher US Treasury yields have weighed on sentiment. He expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.20%.
Well, we have a lot of stock-specific action to track for you. Get to that in just a wee bit from now, but let's highlight the top 10 segment that we're looking at. We're looking at SBI Cards, HCG Ramkrishna Forgings, Century Textiles, HLE Glasscone, and DCM Shriram. All of them will be reacting to positive news flow. While on the flip side, you have Vedanta, Suzlon, Pratap Snacks, and Voltam Transformers that are stocks that could be reacting to negative news flow.
All right, Harold van der Linde, head of Asia Equity Strategy at HSBC, is now joining us. Harold, great to have you with us here on the program. Thanks very much. I mean, actually, it's great to have you with us, particularly because you are an India bull. I mean, you're you're sitting, you've got a bird's eye view of the region, and you like India particularly. And we've avoided the worst of this pullback. So I was just mentioning the Nasdaq is down almost 10%. India is down less than 3%. So people are looking at, as someone yesterday said and put it well, the structural story and avoiding the near-term macro worries, etc. Do you think that will continue, Harold? What's your best sense?
Yeah, I know. I think the macro headwinds will continue actually a little bit longer. Although maybe most of the market response to this we've seen over the last couple of weeks already. What is the problem? The US remains very strong. Inflation is coming down, but not fast enough. It means interest rates might have to stay a little bit higher than what initially is anticipated. You guys have been talking about that. Bond yields go higher and the dollar is therefore stronger. And we think that the dollar can remain strong until the end of this year. So that's not good for Asian equities in general. But what you now see is that the higher yielding currencies and the equity markets where the structural story is simply a little bit better, they perform better. Actually, Indonesia is the other one, and of course India as well. And this is why we are Indian bills at the moment. Will continue to do so. The only problem I have a little bit is that India. We were positive of India, say at the beginning of the year when it was coming down, and we said we're willing to deal with that pain because we think it's a good medium-term story, and that's worked out. But it looks like everybody likes India now. And we see very early signs that some of the gem fund managers are moving some money from India into China. And that's a risk, and we need to keep an eye on that for India. It doesn't worry me too much. It's just a short-term tactical issue we got to keep an eye on.
Okay, so you're the second person in the last 2 days saying that in the next couple of months, I think money is going to move out of India and into China. But perhaps that's expected. But in the medium term, if one wants to sort of reallocate, right, their money into equities, given that we have the interest rate cycle moving higher, given that there are issues like higher Brent crude prices, the dollar is at a 10-month high, do you think India may, as a market, move to the back burner now? Where do your own preferences lie, say, for the next 6 to 12 months?
No, for 6 to 12 months, my preference is still for India. So I'm not overly worried about this. And I think the Asian funds, so people that are really dedicated on Asia, they're not really moving the money out of India into China yet. There's globally emerging market funds that do that a little bit, but it's really on the margin. That's because some policy responses come through in China. Some of the numbers have come through a little bit better than expected as well. So I think it's a marginal issue. I don't think that puts India really on the back burner. The thing is that it just comes at high valuations, right? So for a lot of people say, well, on the margin, maybe I should put some money into China because India is expensive already. So that is the case. But if I look at a 6 to 12 month basis, India is one of the better growth stories across the region for all the reasons that we've spoken about in the past. You've got an investment cycle, you've got a consumer cycle going on, and these sort of things. Indonesia is the same. You've got decent yields if you invest in the currency there. So that provides support to the currency. So there's a lot of positive things going on that make us believe that this rotation is not going to be derail India in that sense.
Hi, Errol. Good morning. I recall the last time around you said that maybe the world is a little bit over-pessimistic on China, which could result in near-term flows moving to China. Though you said that if the funds move there, then it's a good opportunity to get into India. So I recall that when we last chatted. But, what about the Fed? Well, how are you viewing Fed action from here on? The data has come in a little bit soft, at least overnight. And also you have a potential U.S. shutdown. Could that, make the Fed push that rate hiking that you're talking about in November, say by a month or so, and then we don't see that rate hike, which the equity markets are fearing?
Yeah, so you're absolutely right. We spoke about what is it, a month ago or so. I think we spoke about Chola at the time as well. And that is correct. So that on the margin, things could improve in China a bit, and that could take some of the shine off of India. And that's exactly what we've seen. But I would take that as a buying opportunity than anything else. So that view still stands. What my view has changed to a certain extent, you could argue, is that it does seem that the story in the US with regards to the interest rate story, bond yield story has changed. That remains a little bit higher for longer than what we initially, say, a couple of months ago anticipated. And that means the dollar is therefore stronger. So the general headwinds remain pretty much in place. So, yeah, we'll have to see what the Fed is going to do. Sometimes people ask us and say, well, what do you think is the tipping point for the Fed? When are they going to talk about lower interest rates? Is there an easily identifiable catalyst? And I don't think there is one. But what we will see is that some weaker data might start to come through that suggests that the economy is responding negatively to the higher interest rates. And then suddenly the sentiment can change quite quickly. And before you know it, people say, oh my God, in 2024, the Fed is going to cut interest rates. And then we'll be talking about the speed at which they're going to cut. So we're very close to that tipping point, I believe, in Fed talk.
All right. Well, thanks a lot, Harold, for joining in. Appreciate your thoughts here on CNBC TV18. And of course, we'll keep speaking to you through the course of the next many months. That's the word coming in. Yes, go ahead.
Can I congratulate you? Because I believe, I don't know how big a thing this is, but the Indian women's cricket team has won gold in the Asia Games. I know cricket is really big. I don't know how women cricket is in India. I've only played cricket once in my life, and I happen to be in India. But I thought I'll extend a congratulations to you all for that.
Thank you so much. Thank you, Harold. It's a big thing for us here in India. Of course, women's cricket is not as big as men's cricket just yet, but I think it's just a matter of time before it gets there. But thanks a lot for the congratulations. All right. Well, that's a great way to start the day. Let's dip into a quick break on that note. On the other side, our entire team will be joining in to help us with the top stocks. I hope you're having a good morning so far. Our research team is standing by to give you the list of top 10 stocks as we begin the day today. Nigel is looking at Vedanta. Nigel, what's the news there?
Well, Moody's has gone ahead and downgraded the corporate family rating, that's the CFR of Vedanta Resources. Now, the CFR has been downgraded to CAA2 from CAA1. Remember, Vedanta Resources is where the downgrade is, and that's the parent of the Indian listed company, Vedanta Limited. The reasons for the downgrade, they say there are elevated risk of debt restructuring over the next few months. They're also noting that the global conditions itself with regard to financing have got a little bit tight. And the company has not made any meaningful progress with regard to refinancing or any other measures. They're also highlighting there's $1 billion of payments that are coming up by the middle of next year. That's January as well as August, put that together. And that's why they see a bit of a risk out there. So Vedanta Resources gets downgraded. So that's why expect Vedanta Limited to open up in the red. But this could be pushing the promoter entity into a corner. Let's see whether they have an ace up their sleeve, because that's one of the biggest underperforming metal stocks, only because of the promoter issue. So the promoter issue can get resolved in some way, then that will be something that the street should be looking forward to. But negative news this morning. The other one that we're looking at is SBI Cards. Abhishek joins us to tell us why he's looking at that one. Abhishek?
Well, the monthly momentum for the credit card industry has been put out by RBI. So for the industry as a whole in August 2023, card in force has grown by 17% YOY and about 1.6% month on month. Now, spends grew massively by 32.2% YOY and about 2.7% month on month, despite July being a seasonally strong month. So average ticket size grew by almost 13% YOY and about 1.1% month on month. For SBI Card, the strong growth was seen in the spends. Card in force grew by 20% YOY and about 1.3% month on month. Total spends grew by almost 40% YOY and about 5.6% month on month. So average spend per card grew by 16.6% YOY and about 4.2% month on month. So in terms of market share, the cards that have been issued, that market share was at 19.48% when compared to 19.53% in the previous month. Spends market share has increased to 18.43% when compared to 17.93% in the previous month. So going in with a green over there. Back to you.
Abhishek, thanks very much for that. More news flow, and this is important. Suzlon will be in focus this morning, and so will be HCG. Vivek has got both those on his list. Vivek, good morning.
Well, good morning. Yes, Suzlon, an important update coming in. Remember, long-standing shareholders, Dilip Sanghvi and associates, who are part of the investors group of the company, what they've done is they've gone ahead and actually terminated the shareholders agreement that they had with the company. They continue to remain shareholders, that's an important aspect. But what they've actually done is they also had an independent director on board who's also resigned. So what Suzlon says is that, number one, no impact on operations on account of the termination of the agreement. And Dilip Sanghvi says, in a statement that they will continue as investors in the company. They have just taken the decision to terminate the formal shareholders agreement. And also what they're saying is that he continues to remain quite positive on the prospects of Suzlon going forward. Along with that, an important positive development coming in as well. CRISIL has gone ahead and upgraded Suzlon Energy's ratings by 2 notches. Now they have a BBB positive with a positive outlook as far as Suzlon's long-term ratings are concerned. The next stock on our radar is Healthcare Global, HCG. It could be a sharp mover in the session today. Bloomberg, reports that promoter CVC is set to explore sale of a controlling stake in the company. Remember, they hold close to 60.4% in the company, and they are classified as promoters. The report also indicates that CVC is looking at a premium of 20%, and in certain cases, they are looking to upsell up to 50% premium on the current market price. At the current market price, the stake is valued at over 2,800 crores. We tried reaching out to the management, still awaiting an update from them.
All right, thanks a lot for that. Many more stocks in the news this morning. Surbi has the data for us. Surbi, what are you looking at?
The first one on my list is DCM Shriram. Now, the company has underwent a significant capacity expansion on the PVC extrusion at their Kota plant. With this, their capacity will increase to 12,200 metric tons from earlier 8,600 metric tons. Next is Ramkrishna Forgings. There's a board meet on 30th of September to consider fundraise via various routes, including a QIP, and also they will approve a conversion of 46 lakh warrants into shares. Next is Century Textile. The company's arm, Birla Estate, has sold out the phase 1 of Birla Trimaya within 36 hours of launch. Now, the booking value is 500 crores for 556 units. And lastly, Pratap Snacks, the GST authority conducts search in their Bangalore manufacturing facility. The company says that it has extended its full cooperation to officials and responded to all the clarifications, but still going with the red on Pratap Snacks.
Okay, thanks a lot for that, Surbhi. And let's wind this down. Vivek joins us to tell us about a couple of large trades that took place yesterday. He joins us to tell us how is he reading that. Vivek?
Well, good morning. Yesterday, pre-open, we did indicate that there's a large block deal likely to happen in Voltamp Transformers along expected lines. The promoter has gone ahead and sold 12% out of the total, almost 50% stake that he held in the company. Promoter Kunjal Patel has actually sold. A list of buyers, quite strong over here as well. Oxbow Master Fund picking up over 2.5% stake. Kotak Mahindra Mutual Fund picked up over 1.2% stake. Some of the important buyers, including Manulife Equity Fund, Society General. The other stock on our radar, that particular stock ended quite sharply lower in the session yesterday, HLE Glasscoat. Even here, the promoter Himanshu Patel sold 1.5%. Another promoter, Nilesh Patel, sold another 1.5%, and Harsh Patel too sold a minor stake. But the entire stake was picked up by DSP Microcap Fund, picking up over 3.5% stake in the company in yesterday's block deals.
All right, thanks for that. Here's a quick recap of our top stocks with positive news flow. There's SBI Cards, HCG, Ramkrishna Forging, Century Textiles, HLE Glasscoat and DCM Shriram, while stocks with negative news flow are Vedanta, Suzlon, Pratap Snacks and Voltamp Transformers. But the other big headline overnight is what's happening in the world of crude. Brent crude, I think the last time I saw it was $95 a barrel. What's happening there? Manisha Gupta joins in for a roundup of all the action. Manisha, morning.
Oh, well, absolutely. The crude oil prices have extended a rebound, and we're back around 91 and 95 for major crude varieties there. And, the prices have gained up by 25% since end of June. So we are headed for a best quarterly gain since early 2022. The prospects of tight supplies in fourth quarter, Saudi Arabia output cuts, Russia also curbing exports, all of that has been in any case supportive. And then the markets also are looking at decline in U.S. production and inventories and consistent fuel consumption, all of that supportive. The U.S. Oklahoma storage is below minimum levels, and we do understand that the U.S. strategic petroleum reserves also are at a multi-year lows. So markets are looking at support from everywhere. Even as the dollar index is trading at around 10-month highs, we have seen the crude oil prices continue to gain on a firmer note. The pressure, though, has been seen on other metals. So whether it is steel trading at a 6-week lows, gold at a 4-week lows, copper prices trading at around 5-week lows, the metal prices today have started on a weaker note.
Okay, well, thanks very much, Manisha, for that. So that's a quick check on commodities. And of course, the biggest is what's happening with oil. Not good at all. We'll take a quick commercial break here. We'll come back. Devin Choksi of DR Choksi FinServ will be joining in for a quick fundamental stock check, what he's making of things. We'll also have an interesting conversation lined up with Electronics Mart of India. The promoter there is, a promoter entity that is, has sold about 5% stake in the company. But more importantly, beyond that, how is business looking and footfalls, etc. They're a large retail player on the electronic side. So that conversation coming up as well.
Welcome back. Hope you're having a good morning. Global Q is in a bit of a dizzy, and that's why the Gift Nifty is suggesting we pull back close to around 50 points. But plenty of stocks will be moving around. To help us out with analysis, we have Deven Choksi, director at DR Choksi FinServ, who joins us on the show. Hi, Deven. Good morning. I wanted your view on Vedanta. You know, Vedanta Resources has been downgraded by Moody's. It's not the Vedanta Limited stock, but obviously that spells interesting times for Vedanta Limited, and that's been the biggest underperforming metal stock. How would you approach it at around 225 rupees? You know, at current valuations, there is support. The problem is the promoter entity. Your take.
Nigel, good morning. Certainly, I think you are absolutely spot on. The market is lacking the confidence in the promoter entity. Maybe not as much of weakness is being seen in exactly those businesses which the company is running, Indian company, listed company is running. Each of the verticals, be it oil and gas vertical, be it metals, I think mining, aluminium, each of these verticals, I think, are reasonably, I think, performing well. And in a given situation, when we see the bullish outlook on the commodities, particularly at that point of time, I think the fundamentals of this company suggest that I think the valuation-wise, the stock is probably downside risk is very minimal at this point of time. However, as I think the concern is the street is worried about what is happening with the parent company, Vedanta Resources. And any such kind of situation in which they are required to pay off their debt in that part of the world, maybe I think that may force them to book some amount of the assets in the other parts, which is including the Indian listed company. So that could be one of the overhang, and that is the reason for which I think the stock is underperforming. Whether to buy at this point of time, as I said, fundamentals are remaining strong. The downside risk on fundamental metrics, I think, are limited. This overhang goes away, the stock should be performing. That is my
Deven, hi, good morning. Thanks for joining in. You know, there is a very interesting upgrade that has come in. Not upgrade, actually. Morgan Stanley has raised their target price on all IT companies. They're quite bullish, especially on, you know, names like Cyient, Tata Elxsi, Tech Mahindra, etc. And they're saying that there's a double-digit revenue growth coming in for the sector in FY25. Is this a time to be loading up on IT stocks?
Yes, Sonia, good morning. And I think this confirms our view, which we have always put across in the last 6 months, that probably it's basically a good time to buy into some of the IT companies because the fundamental fabric of these companies remains absolutely very convincing and strong. On the one side, the global market needs the Indian IT companies, the service companies, largely because of the fact that there is a higher demand for computing power, which is required in each and every other application. And Indian IT companies are very well positioned. The only situation of challenge was that in last 2-3 quarters, many of the global companies haven't been releasing the orders. And as a result of which, I think the order intake for the companies have remained relatively slow. In my viewpoint, I think as we had viewed this particular subject earlier too, the second half of the financial year for Indian IT companies, we are going to be seeing a reasonably higher amount of impact of new orders coming in. And that too of a long duration, larger size, long duration orders coming in. And that is where probably I think you could see the relative amount of re-rating for these companies. The mid-size IT companies, particularly those who are into engineering and R&D along with, they will probably, I think, relatively do better because they operate out of the niche area of activity. And at the same time, I think the rate of growth in the business for them remains higher along with the margin. So likes of Cyient, which is available at a valuation which is close to around 20 times price earning. And also I think likes of LTTS, LTIM, these are some of the companies which remain relatively more stronger proposition from investment perspective in the mid-tier IT sector.
Okay, fair enough. Just a quick word, Deven. Just one, one more sort of stock, if you want to comment. Voltamp, if you have any coverage, there was that block which happened. Stock was down about 5.5% odd. Any thoughts? I don't know if you have coverage here.
No, Prashant. Sorry, we don't have coverage, so we'll refrain from putting any views right now.
Okay, I do have another, company that we're looking at now. So, Deven, I want you to listen into this conversation. We'll come back to you. Electronics Mart India is the first corporate on our radar today. If you remember, the promoter entity sold 5% stake in the company to meet their minimum public shareholding norms. Let's find out more. Premchand Devarkonda, who's the Chief Financial Officer at Electronics Mart India. Remember, it's the 4th largest consumer durable company and electronics retailer in India. So we'll get a better sense of demand trends as well. Mr. Devarkonda, thanks a lot for joining in. Before I get to the business of things, I wanted to understand, will the promoters look to sell any more stake now that the minimum public shareholding norms have been achieved?
Right now, good morning, first of all. Right now, they don't have any further plans to sell stake in the company.
Okay, so no plans to sell further stake in the company by the promoters.
In fact, there is a capping. Like in a year, they cannot sell more than 5%. So that has already been sold.
No, but once this timeline gets done of 1 year, do they have plans to offload any more stake?
I think this, as of now, there is no discussion around that.
Okay. Can you tell us a little bit about growth as well? I mean, it's been, in the quarter gone by, you've had solid 20% growth on your top line. How are the demand trends at the moment? And is this 20% growth rate something that you can sustain?
It is easily sustainable. We can sustain that 20% growth rate year on year. And in fact, the categories like air conditioners and mobile segments are doing very well. So in the first quarter, we witnessed about more than 30% growth in both these categories. So thereby, I think this year also that 20% growth is possible.
Mr. Premchand, good morning, Prashant here. When you look at consumer durables as a segment, right, and look at, these appliance sales, and I was looking at data for the first quarter, the quarter before that as well, at an industry level, sales are actually down. The industry has not been doing very well. I'm talking about these, ACs and washing machines and, other items. So, what are you doing differently which is allowing you to kind of, grow like this? And what gives you the confidence?
See, in these, in the markets where we operate, that is mainly AP, Telangana states. So where we are the preferred preferred retailer for any of the consumers. And also we have a lot of tie-ups with brands and NBFCs where we roll out multiple offers to the customers. Thereby, I think they are getting the best buy. So that these offers are really like putting us on a different platform as compared to our competitors. In fact, in the first quarter, we have seen significant growth in our top line as well as in the bottom line. And also in all the categories, we have achieved remarkable growth.
Okay. All right. Hi, good morning, Mr. Premchand. A couple of questions there. You're predominantly in AP and Telangana, as you said, but you had forayed into the NCR region. How do you see your geographic mix changing? Because that's one of the largest markets here in India, point number one. And point number two, large appliances. They used to account for more than 60% of your total mix. It's come down to sub 50%. So how do you see the mix changing?
This mix will remain more or less the same because the large appliances will be around 50% and the mobile segment, mobile will be 40% and balance will be the other small appliances and accessories. So that will remain more or less unchanged.
Okay. And geographic split? Because, you made your foray into NCR. That's a big market, big potential as well. So how do you see that changing?
Yeah. See, we were actually, this particular, this summer was the testing period for us in NCR because we are less than 1 year old. As in the first quarter, we were testing that markets. Unfortunately, that season got impacted by unseasonal rains. So we have to wait and see test the waters in the upcoming festive season.
Okay. I just want one number from you. The same-store sales growth in the quarter gone by was around 14%. What can it be in the subsequent quarters?
I think last year, financial year 23, our same-store growth rate was about 17%. And this year also, we are anticipating around 15 plus.
Okay, so 15 plus is what you're looking at in terms of same-store sales growth in FY24, correct?
Yes.
Okay. And, any online or any presence online that you're looking to sort of expand? What is the strategy? Because that channel as well has picked up in a big way. So currently, what are the revenues that you generate from there, and what is the expectation?
See, our online sales contribution has been less than 1%. It's around 1% of our top line. So our focus will be more or less the same. Like we are not aggressive on online platforms. So we want to focus on the existing retail outlets, and we have to establish ourselves in the NCR market, and then we look at other options.
Okay. All right. Very quickly, before we let you go, you're going to be delivering a 20% growth. So on a sales to market cap, you're trading still attractive even after the big run. Two questions. One is, what is the margin outlook? And the second part is, working capital days. What is the guidance you could give us?
Yeah. See, we have to maintain, our working capital is around 60 days. So that's how we have to turn out our inventory. So that should be maintained. And what is the other question?
On the margins, sir. Margins have been around 6-7% odd. Yeah.
That is EBITDA margins you're talking about. EBITDA margins this year will be between 6.5 and 7%. That could be achieved.
Okay. All right. It's been good speaking to you, sir. Thanks so much for stopping by and giving us those details. The stock has had a big run. You're clarifying that the promoter entity is unlikely to sell further, but you're also saying revenue growth will be a good 20% for this year, with SSG growth of around 15%. The stock in the last 12 months is up a whopping 140%. For the time being, we slip into a short break. On the other side, Anuj Singhal will be joining us to tell us how is he reading market setup. And later on, we'll connect with Mr. Ajay Kumar of Healthcare Global Enterprises, as reports suggest that the promoter, that's the PE, CVC, could be exploring sale in the company.
Okay, welcome back. So we've got the opening lined up in about, 13 minutes or so. Anuj is standing by on the big wall with how he's looking at the trade setup. Anuj, good morning.
Morning, Prashant. I'll start with the chart of the day that's sending shiver down the spine of most markets. This is the US dollar index chart. Now, look at the kind of breakout that we have seen. Remember, this is still not at 52-week high. That was at around 116, thereabout. And after that, we had seen a big collapse, which also coincided with a big global market rally. But over the last few days, once after threatening to break 100, it had made a big reversal. And now above this red line. Why is this red line crucial? Because it's almost negating a double top. And last time when you had crossed this line, you had gone all the way up to 115, 116. If you go back to 115, 16, then emerging markets are in trouble. That is the basic point. In any case, the big issue here is the global weakness versus the local macro strength, because global markets going through a bit of a valuation reset because of the sharp move in dollar and bond yields. So overnight bond yields did see a bit of a cool off. The S&P 500 is very close to the 200-day simple moving average. That is the biggest index close to the biggest moving average. I think that's something to keep an eye on. The Nasdaq is already below it. The Indian market is not heavily dependent on ETF flows anymore, but still we do get impacted in the near term. However, in the medium to long term, normally global corrections are the best opportunities to buy. One worry is what's happening in crude though. Crude prices back to almost $95. Now, coming to trade and the levels to watch. On the Nifty, the first support is 19,601. Remember, we had inside day yesterday, so that's why Monday's low is more important, 19,601. Inside day is when the high and low both are within the previous day's range. And the all-important support is 19,545, the 50-day exponential moving average and 10-week exponential moving average. On the upside, the first resistance is around 19,700, yesterday's high, and the bigger resistance is 19,755, the falling 20-day exponential moving average. Traders need to keep taking 40-50 points in this band. It looks like the market will be in this band unless it starts to break either 19,545 or 19,800, then perhaps a bigger swing would come. On the bank Nifty, I think it's very precariously placed. 44,400 the Monday low and 43,830 is the series low. If you break that, then it's possible to go straight to 200-day moving average of 43,000 as well. On the upside, the first resistance comes at 44,773, which is yesterday's high, and the bigger resistance at 45,000, which is the falling 20-day exponential moving average. And of course, keep an eye on HDFC Bank, which has been weak, and even ICICI Bank, where you started to see some kind of weakness yesterday.
Okay, all right. Thanks a lot for that, Anuj. Well, let's shift focus to Healthcare Global now, as reports suggest that the promoter CVC is exploring a sale of its controlling stake in the company. Mr. Ajay Kumar, the executive chairman at Healthcare Global, joins us on the show. Hi, good morning, Dr. Kumar. Thanks so much for speaking to us here on CNBC-TV18. Well, have you heard anything? Your co-promoter CVC looking at selling stake, and I find it quite, startling because they have increased their stake in 2021, and in the last year as well, they've gone ahead and increased stake by buying out some stake from you. Suddenly, they want to sell. Have you heard anything?
No, all I can say is the best people to comment is CVC, who are our partners. I just want to say they have been very credible partners. And the last 3 years, as you know, we have done extremely well. And they have contributed a lot to the growth of HCG. And really on this issue, I also have read the news. And I just really am not in a position to comment. You can take it like probably they'll be the best one to comment on this at this time.
But Dr. Kumar, you're a co-promoter, right?
Yes.
So you're telling us that you have not yet heard from them. But if they're looking at selling, you still have 10% in the company. Will you continue to hold on to that 10%, or there is a good buyer? Reports are suggesting 20%, 50% premium. We have no confirmation on that. But will you continue holding that 10%? Suppose there's a good offer, or will you also look to get out of them?
At this point, as an oncologist and as a founder, my goal is really to drive the oncology to the limits, to the new highs. And because we are very much focused on patient-centric, that is why I was founded HCG, and I will continue to do. Yeah.
No, so that's, Mr. Ajay Kumar, we understand you don't want to commit, but that's neither a yes or a no. So will you continue to hold 10%?
No, I think this news has come. Obviously, this is a major thing. I am very happy where it is now, where I am.
Okay.
So I think if and when it happens, as any private equity would do, at some point, that is an internal decision they have to take based on their models and return on investment and all.
Could you tell us if, without going into what they will do, you would be aware of whether, the fund life is coming to an end or, because a lot of times the motive... I don't think there is any fund life end for them as far as I know. Okay? Okay.
So whatever the news is, it may be related to looking at the return on investment and for them to take a decision.
I want to emphasize
that they are incredibly good partners.
What was their purchase price? Much lower. When did they come in?
When they came in, the stock price, major part of it when they bought the primary came in at 130. About $90 million, 130 rupees a share. That is what they came in 2000.
Okay. Mr. Ajay Kumar, have you had any discussions with them in the recent past?
No, periodically, we get a call from somebody, journalists or the media, and, at that point I do drive them. But their commitment has been there for quite some time. So we have to see what is this news and really the right time talk to them.
Sure. Yeah. No, the reason I'm asking is because do they need your consent in order to get in another strategic partner, if at all?
Now, on the agreement, we are co-controllers until a particular time. So at this point, we have equal rights. Technically, by the agreement, yes, they would require my okay at this point.
And would you be okay with that?
There's so many things which have happened, and I really don't want to comment on that. I am, as a doctor, my focus is on the patient care quality. Yeah. Obviously, I would like to work with them. Let us see, what is this news about. Take a decision at the right time.
So you may have a say in the decision then with regard to who comes in. But Dr. Kumar, who would you prefer? Because in the past as well, the balance sheet had bloated up a little bit, the debt had gone up, and then CVC came and things have gradually improved from there. And from there, the stock price as well, because our audience is the stock market, it's improved quite a bit. Who would you prefer now? Do you think that another PE comes in and believes that there is value from here? Because valuation-wise, you have some support. Or do you think another larger hospital chain comes in there and buys it?
I'm just speaking generally, as you know, whenever any person comes with a publicly traded company, they look at the future growth of this company for them to really invest, as any stock investor does. But HCG is in a very strong position for growth because the number of centers we have had, 24 centers, and we are in a consolidation phase. As we move on to the long-term growth phase of doing even greenfield, brownfield, and strategic alliances, mergers and acquisition, I think our growth strategy can be phenomenal because, we are still not there in several parts of the country. And we are establishing centers of excellence across South, West, East, and North is still lacking.
Mr. Ajay Kumar,
so for us, strategically to grow is there, quite a bit of.
Sure. So I think what Nigel was trying to get at is if and when another strategic partner comes in, would it make sense to get another large hospital chain in? Just to augment the growth that you're looking at.
Yeah, it depends on, of course, the valuation, what if and when CVC wants to exit, what is their level of satisfaction. But I think a long-term partner would be very good for HCG as we move along. But we have to see, the realities of the game and decide. As you know, HCG has had several private equity investors. We have given them successful exits, and we'll continue to do that in the time.
Okay, all right. Dr. Kumar, very quickly before we let you go, obviously, you have not yet heard from CVC, but with regard to your stake, suppose it is a 20% premium, will you go? Will you sell your 10%? Or do you want more than that? Do you believe the company is valued even more?
I think I have diluted some because of my personal need. At this point, I'm really very neutral. I want to really stay focused on it. I really cannot comment on this.
We'll have to have a chat with you then the next time around. In the last year or so, you've sold a couple of percentage points. So it'll be interesting to see whether or not there's a deal in the works. But we look to have a chat with you in the coming week in case something is going on that front. Thanks for joining in. For the time being, though, we'll have to slip into a short break. Up next, we'll have our technical experts who will be joining in.
Okay, welcome back. Just sort of hitting a pre-open session and prices will start to update. Likely we'll get the open that is coming up on your screen should be a lower start, and then we kind of pick up from there. As I said in the morning, I mean, if you get a close like yesterday or the day before yesterday, I think people will be absolutely elated given what the global condition is and the pullback that we are in as well. Remember, from the highs that we've made on the Nifty, we're down about just under 3%, whereas in the US, you have about a 10% pullback already on the Nasdaq, 9.5% to be precise, and about 7% on the S&P 500. So India, in that sense, has avoided the worst of this pullback so far, at least. But will that continue to be the case is the question from here on. Mitesh and Sudarshan both are with us. Gentlemen, good morning. Coming to both of you a little later. Apologies for that. Mitesh, what's your sense? How are things looking this morning?
Morning, Prashant. We've maintained some kind of a negative bias saying that we will see lower levels and the market texture is now broadly still on rallies. I think we are, looking at possibly a test of around 19,400 very soon. And in the worst case scenario, I'm even penciling in 19,200. And on the upside, it will be very difficult for the Nifty to get past 19,800. So I think keep that negative bias on the markets in the short term. I would be worried only if we start breaking below 19,200 because that will then become a medium-term reversal point. But for the time being, I think that's the near-term level which I think will hold, and that's where the markets will possibly head with some volatility.
Okay, Sudarshan Sukhani is also with us. Sudarshan, good morning. It's been almost a 2% cut that we've seen on the Nifty in the last 5 days. Do you see it getting worse before it gets better?
Good morning. It's possible. So the trade really is that we don't want to find out whether this dip will hold or not. Today, there is no buy on dips opportunity. The market is likely to see either choppy action or a significant decline. So in either case, buying is not a good idea. Whether, to your original question, whether we can see a much deeper, much more of a correction, it does appear that that likelihood is opening up. So step aside, do nothing for the day. That applies to the Bank Nifty also.
All right, step aside, do nothing on the indices. But Sudarshan, what about individual picks?
Well, there are some stocks that are doing well. Now, I'm identifying them, but traders must understand that in a falling market, as we can see today, there's no rush to buy them. Just be careful on that aspect. But they are buying opportunities, most of them. Marico is a buy. There was a minor correction that's over. Buy with a stop under 576. IDFC First Bank is a buy. A 5-day, 6-day consolidation broke on the upside yesterday. Buy with a stop under 93. Dr. Lal PathLab, if you remember from the COVID times, has suddenly come up and is now giving signs of strength. So it's a buying opportunity with a stop under 23.70. And finally, PVR is an intraday short, stop above 17.10.
Okay, and Mitesh, what about you?
So I have more of sell calls. To me, Bata is a sell with a stop at 16.35, and I would look for declines to about levels of 15.75. Also a sell on Aurobindo Pharma. It's a conditional sell. It's close around 856, 857 levels. If it breaks 852, take a short position with a stop at 866 for a first target of 825. And on the buying side, a couple of FMCG names. Nestle appears to be getting into some kind of an up move. So buy here. Keep a stop below 22,800. Look for 23,500 as the near-term target. And Colgate had a very strong price and volume action. So if it opens mildly lower, most welcome to buy into this one. Keep a stop below 2040 and 2125, 2130 is what I'm looking at as the target on the upside.
All right, guys, thanks a lot for that. Have a good day. We'll come back to you. The pre-opening session is kicking in right now as we speak. And it's actually not too bad, not too good. It's just ambling in flat terrain. The good part is we haven't really, fallen given the kind of weak global cues we had. So despite all the weak global cues, the market is still holding on to that 19,700 mark. But it's very early days yet. early moments yet, actually. Tech Mahindra, Asian Paints, Britannia are all under pressure. So let's give it some time to, rest, and then we'll, of course, revisit these levels. But the Cricket World Cup 2023, which is scheduled to start next month, is happening, of course, in India, as we know, after 12 years, and expected to provide a boost for the consumption sector. Guys, I was just checking the rates, right? A room in ITC's Ahmedabad Fortune Park is going at 80,000 rupees a night.
Wow.
And that's actually the cheapest. In the Leela in Gandhinagar, a room is priced at 1.7 lakh rupees a night plus taxes. This is during the Cricket World Cup time. So that's the kind of frenzy that we're seeing.
I won't be part of that. I'll be part of the other consumption, the cheaper
Or you just watch it on TV
knocking
better.
it a few and taking it easy.
I don't know if it is true, but somebody said that they are booking hospital beds.
Yes.
Because it's maybe cheaper than, the Leelas of the world.
I'm happier watching it at home. I don't want to sleep in a hospital bed. But Karan Taurani is joining in. He, of course, been tracking this space very closely, and he's the analyst at Elara Capital. Karan, thanks for being with us. Just want to first get your view on, all, of course, the listed entities matter to us. So this kind of boost that we're seeing in consumption, which are the stocks that you track where it could be negative, positive, and, what do you see as the prognosis over the next couple of months as this big event plays out?
Hi, Sonia. Good morning. So firstly, as you said, the World Cup is happening in India after almost about 12 years. So this will definitely boost domestic consumption. You have to see that the time zone becomes favorable when matches are in India. You actually see a big uplift in terms of consumption. Now, these are typically ODI matches, which are about 9 hours. And in terms of potential impact, we believe that Zomato could be the biggest beneficiary of this in the post-COVID era. So when the World Cup happened last time in 2019 or maybe 2011, that time around Jubilant FoodWorks would have been the biggest beneficiary of this because they've got a big clout in terms of delivery. They've got the best user experience in terms of delivery. But in the post-COVID era, we have seen adoption wherein delivery of food has moved to other categories and not just pizza. And Zomato is able to replicate or even do better as compared to Jubilant in terms of the overall delivery experience. So I think Zomato will see the biggest positive impact. KFC, Devyani, Sapphire kind of companies will also see a positive impact. But Zomato will be the biggest, then followed by Devyani, Sapphire, and last would be Jubilant.
Okay. All right. Hi, Karan. Good morning. But, I'm just looking at it. You don't think too much of United Spirits and UBL will be consumed during this period? I mean, as of now, I think you have a reduced rating on both of them. Someone's watching a game. They like to knock in a few. There's a festive season as well. And then you have Christmas. But still, you don't believe you'll want to change your rating from reduce?
So basically, in terms of United Breweries, you will see a positive impact because beer as a category, has got higher on-premise share, closer towards 30-odd%. And because of that, UBL will see delta better volume growth in that particular quarter. But I think if you look at UBL in terms of the overall volume growth, they are struggling right now. A lot of things have happened in UBL. Management changes happened. They've changed route to markets. They've scaled down certain markets. Local brands have also gained market share at the cost of UBL. So I think UBL could just see one quarter of a small positive impact, but over the near to medium term, there are concerns. As far as United Spirits is concerned, I think, it is only the upper prestige segment, which is the Scotch or the BII and the BIO category, which has a 40 to 50% kind of an on-premise share, and you will see some respite over there. But in terms of overall contribution, it is quite minuscule. And the kind of valuations both these companies are trading at, somewhere close to 50 to 253 times FY25, we believe that a lot is priced in, and one can't really see potential upside in the near term at least.
Karan, slightly tangential, but I'm sure you would have seen that post yesterday, which went viral on Indigo's F&B revenues being greater than, what Barbecue Nation and a few others. People were highlighting it. Although somebody did say that, it's kind of hard to go out and get options when you're flying. So, that helps. How do you look at that? I mean, and any thoughts?
Yeah, so generally, I think food revenues, across various consumption sectors have picked up. If you look at cinemas as well, they are also operating at a reasonable scale as far as food revenues are concerned. But what you have to really see here, for the listed companies is that the competitive intensity in the pizza category has become very high. Secondly, I think Jubilant as a company, if you look at them, their focus is kind of now changing towards from delivery to dine-in. Because delivery SSG is not growing faster because peers are competing hard there. You have got Zomato who are playing, and Zomato also has scaled up over the last 2 to 3 years. So I think from that standpoint, pizza is a category which kind of sees stiff competition, and you may not see this kind of growth. In fact, even look at the market share numbers over the last 3 to 4 years, pizza has lost market share as a category within the overall QSR chain. So I think it's a win-win for burger, fried chicken, for aggregators like Zomato over the near to medium term.
Okay, let's talk about TV and digital platforms, right? Because the expectation is that this World Cup will generate almost 2,000, 3,000 crores of ad revenues. So from that entire space, who do you think would be the biggest beneficiaries?
So I think from that entire space, of course, it's going to be Disney who's going to be the biggest beneficiary. So I think if you look at World Cup historically, in India as well, and even overseas, whenever it's happened, it's not clashed with the festive quarter. So I think it's the first time there's a clash with festive. So you will see a big amount of ad spends, moving towards World Cup. That might have a mild negative impact on players like Sun TV and Z, which are more GEC focused. So sports will see a big win-win as far as ad spends are concerned. And Star Disney will be the biggest beneficiary of it. And also, I think the consumption this time around will be better for World Cup on digital. We'll see better growth rates there because, you can do catch up as per convenience. The matches are 8 hours, as I told you. And also this time around, the World Cup is being offered free on the OTT platform.
Okay, all right. Karan, thanks a lot. The hype is real, right? And it's all going to begin on the 5th of October when the first match kicks in. So, of course, all of these sectors, whether it's hotel stocks, whether it's beverage companies, television companies, etc., all of them are going to do pretty well. Thanks, Karan, for putting the spotlight on that, on the consumption sector, rather. But let's do one thing. Let's get back to talk about individual names. Abhishek, my colleague, is joining in. He has AB Capital on his radar. Abhishek, go ahead.
Well, Sonia, Jefferies has initiated coverage on AB Capital. They have given a buy recommendation and a target price of 215 per share. They say that the financial conglomerate is on a strong growth path. So AB Capital is poised to double its profits in next 3 years. The NBFC segment can gain from the MSME lending opportunity as it expands branches, leverages the low cost of funds and shifts towards the low ticket size. So valuation seems reasonable right now. Over FY23 to 26, they estimate for AB Capital that the NBFC profit growth will be seen at a 29% CAGR and ROE, that is return on equity, can rise by 140 basis points. The HFC segment, 23% loan CAGR growth with an 18% profit CAGR growth and ROE slightly to 14% despite pressure on the net interest margin. Insurance, they estimate 26% CAGR in the VNB, that is value of new business, and in the AMC business, 11% CAGR in AUM, which will be led by 12% rise in equities. However, top line growth can lag a bit over there by 7% CAGR estimate between FY23 to 26, and they estimate 10% CAGR on the profitability of the AMC business. Back to you.
All right, thanks for that. Well, the other space we're looking at is IT. Morgan Stanley has raised their target price for many of these stocks. So Reema's here to quickly put the focus on it. Reema, over to you.
Thanks so much for that. So on an average, Morgan Stanley has raised the target price across the IT companies, the large caps, the mid caps, the ER&D companies, anywhere between 11 to 29%. And that list will come up for you on your screen. The old target versus the new target. Now, the reason for this is one, they are quite confident that IT companies will be able to clock in double-digit revenue growth next year. This is above consensus. Secondly, they also expect margin improvement. The margin improving trajectory should start from Q1 of FY25. But within that, there are certain changes. Now, Tech Mahindra has been downgraded. They have increased the target price on Tech Mahindra, but the rating has been downgraded because of the kind of rally the stock has already put in. Tech Mahindra's stock is up 29% on a year-to-date basis. Cyient has been upgraded. They say that already the stock has done well. It's trading at premium valuations versus historical levels. But according to them, the re-rating will continue. The three overweights Morgan Stanley has are on HCL Tech, LTI Mindtree and Infosys. On Wipro, they are underweight because they still think they don't have confidence about Wipro closing in the gap versus peers on growth. And finally, on TCS and Emphasis, they have an equal weight. It's the high valuations which prevents them from going overweight on the likes of TCS. Back to you.
All right. Thanks a lot, Reema, for that. Just in time for the market opening. 30 seconds left for the markets to open today. It looks like it's going to be a decent opening given the kind of global cues, a steep sell-off we saw across Wall Street. This is not a bad showing, at least at the early tick. Let's see, we'll take it from there. The Nifty hanging on to that 50-day moving average of 19,650 thereabouts. And the first trade going to kick in just seconds from now. There you have it. Not a bad opening given the kind of cues we have. So the Nifty is down about 30 odd points, but still subdued. The Bank Nifty is down 150 points almost and exerting pressure on the market. And Sensex is down over 100 odd points. The space that's getting hit the hardest, and something you were mentioning earlier, is technology. Tech Mahindra, HCL Tech, Infosys. Remember, globally, the Nasdaq saw the most amount of pressure overnight. And there's a little bit of a rub-off impact that you're seeing in our markets as well. Hindalco is the other big loser, down about 1%. HDFC Bank, SBI Life, Bajaj Finance, are a couple of other names that are following suit on the downside. Britannia as well is down about 0.3%. So, look at that stock too. On the upside, you have pharma stocks which are doing well, holding the fort today. Cipla, Dr. Reddy's, Apollo Hospitals, Divi's Labs are all trending in the green right now. LTI Mindtree is up 0.6%. You have Coal India that's up 0.3%. And something like an Ultratech Cement and L&T are also trending in the green. So overall, it is a subdued start to trade, but yes, it's veering towards the red side. So the sell-on rally is something that, the market has sort of seen over the last many days. The trend is on the downside and it's reflected today.
Well, that's right, Sonia. Let's focus on a few stocks in the broader markets. Vedanta Limited, that one's down closer on 3%. Problems at the promoter entity front, with regard to Moody's downgrading the rating on Vedanta Resources. Because the promoter's in a bit of an issue, that's why the pressure is being felt on Vedanta Limited, though valuation-wise, it's getting very, very attractive. Next up, Healthcare Global. We just had part of the promoter, that's Dr. Ajay Kumar, who joined us on the show. He said he's not aware with regard to CVC's plans, but reports indicate that CVC, the PE that got in 3 years or so ago, they could potentially be looking at a buyer. So because of that, that stock as well is up 3.5%. HLE Glasgow, yesterday in the final minutes of trade, we saw close to 3.5% equity that got changed. The promoter entity was the seller, but DSP Microcap Fund, they bought that 3.5% odd. So the street seems to have liked that. Remember, the promoter entity deal happened at a discount of 10% in comparison to what the stock was trading at. It happened closer to around 505 odd, while the stock price was around 550 at that point of time. And finally, AB Capital, Jefferies, they have initiated a buy rating out there. Target price 215 rupees. A few factors that they're considering. They expect the profits to double in 3 years. They're expecting 29% EPS growth in the next few years. And the ROE is expected to move to around 16% odd. So that stock as well is moving up. Just one more stock on the downside. You have Suzlon. That one is seeing massive volumes in the initial few minutes. Dilip Shanghvi and his associates have terminated the shareholder agreement. And also their board nominee, that's Mr. Hiten Timbadia, he has resigned as a director of the company. The company has gone on to clarify that there's no impact on operations on account of termination of agreement. But for the time being, the stock a little bit subdued, down 2.5%.
Well, so this is a decent open, I would say, given the global context. I mean, we're down 40 points on the Nifty, which is nothing, right? I mean, just 0.25% after overnight 1.5% cuts that we've seen. But this is just the start also. And we are opening around support levels. I mean, another 20 points. So 19,600, 605 to be precise, where supports come in. That is where exactly the market, the Nifty took support on Monday, the day before yesterday as well. So, we'll watch the open and how a trade progresses from here. Vedanta is down 4%. It's the largest volume traded loser coming up on your screen. And look at the volumes in that, upon 2 million shares, 2.2 million shares straight off the bat on Vedanta right now. Bajaj Finance did well. Bajaj Finance is coming up with a small cut, but nothing large. Dixon is down about 1%. It's, again, nothing large. These are small cuts, but they've got volumes, so maybe things pick up here, so keep an eye. Zomato is down about 0.6 odd percent, and then there is Tata Steel, which is down about 0.75% as well. I have to point out that at least at open market breadth is still positive. You got about almost 1,100 stocks higher and just under 700 stocks which are lower right now. Now, a few names on the upside. The largest volume gainer is Cyient. Cyient is up 4%. Stocks at 1735. It'll come up on your screen. Apar Industries had a big move yesterday, 5%, and today again it's a 3% move, 59.80 on Apar Industries. There is Shreyas Shipping. Never seen this one right at the open coming up with volumes, but it is. Shreyas Shipping is at about 470. I think yesterday was a large mover. Today it's up 11% on the back of volumes. Over 500,000 shares on Shreyas Shipping. What else? There is Borosil Renewables, which is coming up with an 8.5% gain. Decent sized volumes for this point in the day. Century Textiles is up about 3.5%. HLE Glass, of course, Nigel mentioned. There is Jupiter Wagons and a few others which are coming through as well. But this is the bulk of the big volume-led gains that we are able to pick up in the broader market space. So more as we go along. And usually in about 15-20 minutes or so, there's a fair bit more in the mix. But Gautam Trivedi is co-founder and managing partner at Nepean Capital. He's joining us now. He's also someone who watches the global action pretty closely. Gautam, good to have you with us here. Thanks very much. Are we at a moment where things are starting to pull back, cool down a little bit globally? Seems to be the case, although here in India, we've been insulated from the worst of it. The Nifty is down just about a little over 2.5% from its highs. In the US, on the NASDAQ, it's about a 10% cut now.
Yeah, I think one thing you've got to keep in mind, and I've said this before on your channel, is that this is not an India rally alone. This is a global equity markets rally. So you've seen the Nikkei hit a lifetime high, the DAX hit a lifetime high, the Francis CAC is at a lifetime high, the US markets are near lifetime highs, and of course, as is the Nifty. So we're not alone in that global equity rally. The other thing to keep in mind is that the correction which has begun, as you said rightly, it started off from the US. And if I look at the absolute numbers, the US clearly, the S&P 500, for example, is down almost 3% this month alone, whereas we're not down as much, but actually still up, and the Nifty 50 still up 1.6% as of yesterday's close. But I think the sell down, which has started from the West, will hit the Indian equity markets. And if you look at the absolute FII numbers, $1.5 billion this month alone of selling. But again, that fails in comparison to the $19 to $20 billion that we've seen since April of this year coming into India from foreigners. So I think some of that correction is required. I'll be actually a very happy person if that were to happen, because some of the stocks in general are very, very expensive. India is now officially the most expensive market in the world. So I think if you've got the MSCI India trading at 20 times and you've got the S&P 500 at 17.5 times, and if you're a US investor, you would think twice about putting incrementally more money to work in India. And that's exactly what we're seeing this month.
Okay. So if there is incremental money that's coming into India, we have a couple of big events upon us, right? There's, of course, the general elections coming up. And if you go by history, in every election year, the market has either in the run-up to the election year or post-election year done pretty well. Is that what you're expecting this time around as well? And in the anticipation of the markets doing well, where do you think one should pump their money?
I think, yes, I agree with what you said. Historically, that's happened. The factor is, and the question is that I've been asked all the time. I was in Hong Kong 2 weeks ago, and the two markets that were clearly in focus of all my ex-colleagues who are now fund managers at various firms that I connected with said the two markets that they are focusing on are Japan and India in Asia. So, but having said that, the one key risk that everyone is asking me, and you and I, nobody has an answer to this, is will Prime Minister Modi get a third term? If that were to happen, I think India has a breakout moment. If it doesn't happen, I think there will be, I suspect, about 2 or 3 days of a massive buying opportunity. But what's going to be the outcome at this point and how that's going to impact the markets, it's really hard to tell.
All right. Hi, Gautam. Good morning.
Hi.
I want to discuss about a lot of stocks about you. I recall you told us the last time around as well. You believe that the mid-cap space has run a little bit ahead of itself. So I guess you're holding that view even now. So tell us about that. How would you approach the mid-cap and the small-cap space? And we'll take the conversation forward.
Sure. Now, if I look at the universe of the BSE 500 stocks, 450 stocks are up 20% or more from their respective 52-week highs. And that compares to the Nifty, which is up 19% from its respective 52-week high. So that gives you a sense of how broad-based this rally's been. It's not been limited to a handful of stocks, which is the good news. The other thing which I noticed in April of this year, of the universe of BSE 500, 300 stocks were down 20% or more in April of this year from their respective 52-week highs. Today, that number is only 70. So that's the kind of rally that we've seen that's been so broad-based, not to mention the fact that over the past about 2 years, we've seen another about 75 to 80 stocks having their IPOs and getting listed, and a lot of them have done extremely well. So I think from that standpoint, the rally in the broader market, even if you were to look at the Nifty 500 year to date, it's up 11.5% versus the Nifty 50, which is up 7.5% in rupee terms. So I think this rally clearly has been broad-based. And while optically the Nifty 50 does look expensive, or the MSCI India, they both look expensive, there are enough stocks that haven't joined the rally, and potentially if this correction is a minor correction, which I think it is, I think some of these underperformers should basically start to see traction.
One of the biggest underperformers, Gautam, has been HDFC Bank. Valuation-wise, it's looking good. The recent presentation as well as analyst meet, that's what made the street even more nervous. But it's holding at crucial technical levels, and fundamentally as well is looking up, right? 2.5 times price to book near term. I mean, if you look at it on 2025, 2.1, 2.2 times. Your view on HDFC Bank, is it presenting an entry opportunity, or would you get in at a lower price if you do get that chance?
I think it's presenting an entry opportunity. Who would have thought HDFC Bank would trade at 2.5 times when it's historically been at anywhere from 3.8 to 4.5 times 1 year forward price to book? Must tell you that we own the stock in our portfolio, but yes, we are bullish on that company. I don't see the stock necessarily having a huge outperformance within the next 6 to 9 months. But I think after that, from a long-term perspective, it will certainly do well as the synergies of the merger start to kick in.
We were just having this discussion with another analyst on how consumption patterns are expected to surge now that we have a big event upon us, which is the World Cup, right? Do you believe that this is a structural story, whether it's hotels have, of course, done very well up until now, but some of these platform companies like Zomato, some of these beverage companies, United Breweries, United Spirits, etc. Do you like this entire theme?
I think the theme is good. More Indians are waking up to, the ability to order stuff online and the convenience of their homes. So that's clearly a good sign. How it's going to impact revenues, we haven't really looked into that. And I think the World Cup, of course, is there for 3 to 4 weeks. And I guess after that, the question is what happens after that, whether it's hotels in Ahmedabad, which are going at whatever, $500 a night. That's a temporary phenomenon, and I think we got to look at what the longer term, medium to longer term impact of these businesses are going to be.
Gautam, sorry, just to get that near term out of the way, you think this is your base case is this is going to be a short-lived correction overall, right? And yes. Sorry, but that is our base case correction, because the absolute fund flow in the system globally is still so strong. We don't see any significant signs of a slowdown. If you look at just even in India, even the fact that interest rates have gone up as high as they have, I mean, today you're getting AAA rated NCDs anywhere from yielding pre-tax 8.5 to 10%. In spite of that, the money that's coming into the equity markets from domestic investors, is unabated. It just continues. So I think as a result, I don't see that much of a significant correction coming into the market, unless, of course, something very significant externally happens. But I don't see any domestic factors in the near term over the next about 8 to 9 months impacting the equity markets negatively.
Okay, how would you position yourself, Gautam? In the past, you've given us your breakout between fixed income, equities, as well as real estate. At this juncture, what would it be? If you're allocating money, how much of it would go to each of these asset classes?
Yeah, I think, when I look at real estate as an asset class from an investor's perspective, and I talk to the real estate developers, I still haven't seen evidence of investing coming back into the real estate sector. A lot of it, for the most part, is real demand, as in people wanting to buy a home and move into it versus buying 2 homes or 3 homes and hoping to flip it once the project's complete. So I think it's still real demand-led. It's not so much investor-led from a real estate perspective. But I think if you're cautious, given how expensive the markets become, and as I said, I hope there is that correction and it remains minor. I think getting positioned in some sort of cash for that correction and then buying into that correction, I think would be ideal. That's the way I would position it.
Okay, this entire consumer durable space is a space that interests you now. Of course, valuations are a bit, expensive here. But in this whole consumption theme, is consumer durable something you like?
I think the way to look at this is, and I think the return of real estate, residential real estate, after a span of, I guess, about almost 8 to 9 years, I think is a big driver of a lot of other businesses. If you look at the white goods, I mean, when you move into a new house, you need a new refrigerator, a new microwave machine, washing machine, etc. You need lights, fans. You need, what's behind the wall. So a lot of that, I think, is being driven primarily by, people buying new homes, having made money either in the stock market or in their existing businesses. And basically that also is to some extent also incrementally driving consumption of automobiles. So I think a lot of these businesses actually positively benefiting from the surge in real estate demand.
All right, Gautam, we'll leave it at that. Thanks a lot for joining in and giving us your views on a whole host of sectors and on the market. By the way, just a quick check on what's happening in the market. It's not going anywhere, but it's still a bit subdued. So down about 50 odd points for the Nifty. The mid-caps are actually having a better showing, up almost about 116 points. So it gives us a cue to take that discussion forward. Very interesting, stock that we're tracking next. Of course, very well owned as well, Amber Enterprises. But what's happened is the company's arm, ILJIN, has entered into a joint venture with Nextbase. Now, Nextbase is the company that manufactures a very popular smart wearables brand called Noise. You must have seen, the Noise headphones, and a whole host of other smart wearables. And now Amber has entered into a joint venture with them. Jasbir Singh, who's the Chairman and Chief Executive Officer at Amber Enterprises, joins us now to talk more about that. Jasbir, thanks a lot for joining in. Appreciate your thoughts here. This is a very interesting JV because, it's with a brand that is growing by leaps and bounds, right? Noise over the last many years. Just wanted to understand for Amber, what does this mean? Is there any kind of investment that you'll be making? And in this wearables division, you have, of course, seen a good growth in the electronics division. You've seen a good growth over the last couple of years. How will this augment growth there?
Thank you. Good morning. Thank you for having me on the show. Yes, we are pretty excited for this joint venture with Noise. Noise, as you would know, is as per the latest IDC Q2 report, they are the world's third largest now and India's number one, having 27.6% market share. So we are going to develop local comprehensive integrated solutions in the wearable space in this JV. And the new JV will have a new plant set up, giving a local solution in the wearable space. And we expect a good kind of a growth in this complete at ILJIN level. So in ILJIN, I would like to tell you that we just started by acquiring this company in 2018, which was just purely assembling PCBAs for consumer durables. But now we have wearables as a vertical within that ILJIN Electronics, and then we've added telecom products. So we are adding, and it's a good EMS play which we are seeing in the electronics division of ours.
Okay. In fact, I've been a personal user of the Noise AirPods as well a couple of years ago, and I must say that the quality is at par with a lot of the global, the best of the best wearable companies there. And of course, the cost is, I think, 1/10 or so. So you're doing a good job so far. But tell me a little bit about the wearables division now that this JV has come through. For you particularly, I think 15% of your business comes from the wearables markets. How much do you plan to grow it to over the next couple of years? And what would this mean in terms of the absolute revenues that you're looking to get currently, which is, I think, about 340, 400 crores?
Yeah, so last year we did about 1100 crore in ILJIN, and out of that, about 300 odd crores was the wearable sector. But because of this JV, we expect the JV to bring in about close to 1,000 crore plus top line going next year. And then, of course, moving ahead, because Noise is gaining market share. And as you said, that quality products and a very good design team they have. Very interesting products are going to be launched, and we are very excited.
Okay, all right. 1,000 crores of revenues, which is currently at around 350 crores. Did we get that number correct?
That's right. Yeah, that's right.
So this is by FY25?
Yes, FY25. So that is what... Yeah. So it is a proper import substitution story and assembly as well as manufacturing of components for the wearable part.
What would the margins be approximately in that vicinity of around 4–4.5%?
Yes, I think the industry moves around that margin, so we will be in line to the industry margins.
Okay, Mr. Singh, good morning, Prashant here. There is intense competition in this space, isn't there? Would you be able to hold on to these margins, or will there be a gentle downward slope over a period of time? Even as volumes are humongous and the market is humongous, will margins slope lower over a period?
No, I believe as we backward integrate into the components part and bring in the local value add here, I think margins are sustainable. And perhaps it could grow as well, because Noise is planning to bring some more interesting products. They're launching some new categories. So I believe, yes, for the time being, it is definitely sustainable.
And this 1,000 crores will continue to sort of grow at what kind of rate beyond FY25?
Well, I think Noise, looking at the history, they have been growing in double digit in last couple of quarters. So we expect that they will continue to grow that way.
Okay. So currently Noise has a large presence in wireless earbuds or smart watches, right? Neckband earphones, etc. You said that there are some new categories that they're looking to get into. Which ones are they, and what is the timeline in terms of a rollout as well? When would it start sort of contributing to ILJIN?
Well, that's little company-sensitive information. I like to avoid what kind of products they're going to launch. So, but yes, you will be hearing, every quarter they are planning to bring in some new categories.
Okay. So I just want to understand, because so you're saying the manufacturing will be from Noise and from Next Base itself, right?
Yeah. So it is a 50-50 JV. So
yes.
It will be set up in Noida, which we are planning to bring in. And in this setup, we'll start with the wearables and then move on to the other electronic products.
So would this mean any fresh capex that you would have to put from your end? If yes, what would the amount be?
It is not a very big capex. We've already invested because we've already started wearable sector last year itself. So over and above, top of that, I think we will be investing about 10 to 15 crores in next year for that.
Okay, that's a small amount then. So we've spoken enough about this JV. I want to understand business on the whole, Mr. Singh. In the last few years, you have undertaken big capex. And because of that, some of your return ratios have looked a little bit subdued. But now things will start improving as you start utilizing those facilities. So my question to you is, what is the utilization level? And in particular, what is the utilization levels of those new facilities that have come on stream? Because in the next few years, you're expecting the ROC to move towards high teens. Please give us further details.
You're right. Actually, we've done about 1,100 crore capex in the last 2 years. And that was primarily for greenfield facilities which we have put in. So those are right now, they have started operations, and we are at about 35 to 40% of utilization. As we move ahead in coming 2 years' time, we will move this capacity utilizations of the new facilities to at least 60–70%. And that's how we expect the return ratios to improve. So we've already jumped from 11 to 15% last year, and this year we expect at least 16 to 16.5%, and then moving towards 18–19 number in coming year to come.
So the ROC will be 19–20% by 2026?
That's right. Yeah, that's what we guided earlier also in the market, that in next 2 to 3 years' time, we should be in the range of 19 to 20%.
Mr. Singh, could you tell us how has been the season, this particular season? I mean, Q2, just some color. How's it gone?
Q2 is positive as compared to last year. Q1 was a dampener because of the unseasonal rains. But on the RAC side, RAC division side, Q2 is positive. And we've also won a couple of more contracts in our railway division, which is Sidwal, where we have onboarded new customers and new product categories of gangways and doors and pantry systems, along with the HVAC systems, which we are giving in the railway subsystems.
How much is this mobility right now as a percentage of revenues, and how is it expected to grow?
So last year we did about 420 odd crores. This year we are expecting that it will grow at 20 to 30%, and it will grow at a range bound of 25 to 30% because we've added new product categories. So we are now getting deeply into the railway subsystem part. And apart from, we started as HVAC for railways, but then we graduated into metro space and defense application plus data center air conditioning. And then now we are entering into the other product category. So we want to be multi-product category supplier in the railway subsystem moving forward.
And you're doing all metros, sir?
Yeah, my metro air conditioning plus we have done technology transfer agreements with the Taiwanese company and a Canadian company for doors and gangways, and we have developed pantry systems. These are new product categories which we have added in that.
Sure.
And what is Sidwal's current order book? I think the last updated number we have is around 700 crores.
Yeah, it has gone little up. It is now about 840 odd crores as we speak today.
Okay. Can you tell me for FY24, what is the kind of revenue that you're targeting? You're sitting on about 7,000 crores of revenues as of FY23. What is it? Is it 10%, 15% plus that you can eke out by the end of FY24 or better than that?
Difficult to project that way because it all depends on how the Q4, especially the room AC division, is going to have. Well, last year we saw that there were seasonal rains. But yes, I mean, we've guided that we will maintain about 25 to 30% on the bottom line improvement this year, irrespective of the revenue percentage.
So, okay, 25 to 30% on the bottom line growth by the end of FY24. Earlier, you had said the electronics division growth will be about 25 to 30% this year. You stick to that, or do you think it could be better?
It could be better now because we've joined on the JV as well as we will be starting very soon, and we are adding some products in the telecom division in ILJIN. So we are excited. I think we can cross 30 to 35%.
Okay, 30-35%. I just have one last question because, you know, I mean, we started by talking about how there is a big opportunity here, right? If you just compare, I mean, noise earbuds, for example, are costing what, about 1,700 at the max to 2,000 rupees. If you look at Apple earpods, they're at 17,000. So there is a huge price differential that you're seeing with domestic manufacturers, right? Any more such JVs or tie-ups that you're looking to do to capitalize on perhaps this opportunity in the Indian market?
Yeah, we'll be looking forward because you see electronics division, which is ILJIN, is now becoming number 2.0 story for us. So we will be, as I explained, from air conditioners, inverter PCB board, we graduated into consumer durable, refrigerator, washing machine, microwave oven, PCBAs. Then we've entered into wearable and telecom sector. Plus, we are now opening up automobile EV sector in that division. So overall, this division is becoming a EMS play, electronic EMS play, where we expect to deliver very comprehensive solutions to the industry. I believe it's a very interesting space. If we speak about wearable space, in the world, there are about 504 million units of wearables sold, and out of that, around Indian industry is expected to be 130, out of which, you know, noise is the largest today, sitting on 27.6% market share. So pretty excited. I think this is a big opportunity, and moving forward, we should form more alliances to get into the backward integration of this component space.
Is this exclusive? With noise, the tie-up, is it exclusive?
Yes, I mean it is exclusive with noise, but this JV will be catering to other brands also moving forward, because we are giving a complete solution, and it's not going to be only domestic play; it is going to be a global play from mid to long term perspective also.
Okay. You know, we had the management of Dixon some time back, and I asked them, what is the way that you will be able to get into the Apple sort of ecosystem, the supply chain ecosystem? So I want to just ask you that. Any way you can crack that? Are plans afoot? I mean, is it possible in the foreseeable future?
So everything is possible. You know, we started our history as a sheet metal fabrication, and you know where we have reached today. So I think what Indian companies need to do today is to start focusing on R&D and also go backward integrated level. So we are one company which is very focused on the backward integration. In air conditioners, we can give you 70% of bill of material and complete products Similarly, we would like to attempt this strategy, and I think with that kind of a strategy, as once we backward integrate into the component ecosystem of the PCBAs, there can be opportunities moving forward.
You know, one big shift for Amber, which you've kind of told us over the last few times we've had you on, has been that from making ACs, you're now getting into components, because, I mean, OEMs are making their own, but that's also more profitable, you know, the components side of things. Is that strategy well on track? And if you can give us a quick update.
Yeah, so right now we are at 29.4% of Indian manufacturing footprint of room air conditioner space. And as a solutions from finished goods to components, so brands do change their strategies. They do calculate and make versus buy. So we've mitigated that risk. Whenever this shift happens, we supply more components. And yes, you're right, components, some of the components have better margins. In the air conditioners, what happens is compressor is supplied generally by the brands, or we procure it, but that adds to the top line, which we are not producing on our own. So in the component space, like heat exchangers, sheet metal, inverter PCB boards, copper tubings, CFFs and all, that is better margins than the finished good. And also because of our scale and the geographical presence, today we have 27 plants in India in different geographies of India. So that brings more leverage on the purchase side as well as you know, on the offerings to the customers.
Got it. Just last question, sir, from our side. Are you sort of going to get into laptops as well?
We are not looking towards the assembly of laptops. What we are looking towards is in the IT PLI part on the backward integration side, on the component side. So we are developing some plastic products. We are doing some sheet metal products in that category.
Okay, but you know, you have a better understanding than most about how this works, even though you're not getting into that segment. You must have read reports recently that there has been meeting between the government, MeitY, and industry stakeholders, and there seems to be a substantial dilution in terms of what was proposed. So, you know, the date when these restrictions of import of laptops, you know, this apparently has been pushed out by a few more months. You know, instead of licenses, now they're talking about the process being made online. There is also perhaps a quota system from FY20. So compared to what the market was expecting, that this is a big block opportunity which will suddenly come to Indian manufacturers, there seems to be a fair bit of dilution. Is that reading correct?
No, it's not a dilution. It's actually, you see the narrative. What government wants is complete import substitution. Government wants complete self-reliant India, you know, in every sector to speak for. So there is a direction from government to...
No, that is correct. But compared to what we assumed earlier, with what we are hearing, does this seem marginally, at the margin, some dilution?
I don't think so, because, you know, the licensing system has already been onboarded. Brands can apply, customers can apply and take the license. Similarly, case was happening, and we can see the TV getting manufactured in the country today. 100% of largely it has complete imports have stopped in that category. So that shift we expect in this sector also.
All right, Mr. Singh, thank you very much. Great speaking with you, sir, as always. It's a pleasure hearing you and the plans at Amber. Thanks very much. Well, 55 points lower on the Nifty. We're at, 19,610. So it's right there. At pretty much the lows of Monday, which is also an important retracement level, as we've been pointing out. We'll take a quick commercial break here. On the other side, there's an exclusive chat with the coal secretary coming up on the demand-supply dynamics and, of course, you know, what that means for the sector. Stay tuned. That conversation coming up.
Welcome back to Bazaar Morning Call. This is an important conversation. Nigel spoke to the Coal India Secretary Amrit Lal Meena and quizzed him on a whole host of issues, but started by asking him on the current coal demand supply dynamics, since there has been a surge in power demand lately. You want to listen to this one.
Coal is being supplied as per the plan we have envisaged in the beginning of the year. The production of coal is showing a growth of more than 10% this year. Last year, you know, it has grown by 14%. So all Coal India Limited, Singareni Company, and the private sector coal mines, all are contributing as per their plans, and there is actually no shortage as far as the plant supply is concerned. You are aware that certain grade of coal is imported in the country, but the share of imported coal in the total coal consumption in last 5 years has gone down from 26% to 21%. So every year there is reduction in the total share of the imported coal. This is happening through enhancement in the production of coking coal, and of course the thermal coal production is going up. So this time there is adequate availability of coal, but you know the coal has to be transported from the coal producing areas to different parts of the country.
Right.
So some of the far off consumers may find it little difficult because of the logistic constraints. So to some extent the consumers are importing. As far as the import for the power sector is concerned, it is being imported for the imported coal-based power plants located in the coastal areas, and about 2 million ton per month is generally being imported by those GENCOs and those power plants which are located near to the ports.
Got it. All right. So the short point, sir, is you're saying that there is no shortage of coal. Give us a couple of more numbers then. Are we ready for, peak power demand that could pick up? And also, if you could tell us this imported number, as you told us, it's come down drastically. Do you see it go down further from here?
See, as far as the power demand is concerned, you must be aware that in August, from around 10th of August till, end of August and beginning of September, there was massive surge in the power demand because of the long dry spell of the monsoon in various parts of the country. Power demand has shown very significant peak. So during that period, the coal availability to thermal power plant has been ensured. And now we have stocks about 23 million ton at the thermal power plant end. And now, as you know, news is that monsoon is retreating. So the supply to thermal power plant will increase because the production will go up. So now stock building will happen. And as the winter comes in, the consumption will go down. So at all thermal power plant, the stocks will build up.
Okay.
We have plans that by the end of March 24, we should be having a stock of about 40 million ton at the thermal power plant end, and another about 75 million ton at our mine head.
Got it. All right. So you're giving us a fair bit of clarity then. The other aspect that we look at is coal demand is there for sure. And also international coal prices have been moving up a little bit. But for Coal India, the price increase that came about on the FSA sales was only on around 30% of their output. My question to you is, could there potentially be another price increase coming in on the FSA sales of Coal India? Or do we have to wait for post the elections to see another price increase?
See, the coal being supplied from Coal India for the thermal power plants, it is supplied at the notified price and will continue to be supplied at the notified price. The quantity of coal beyond that, which is not covered under FSA, is made available to other consumers through the auction route, and adequate coal is available for availability through the auction. And you may be aware that in January 23, e-auction was offering a premium of 180 to 200%, but now in July, this premium has gone down to 80%, showing that the availability of coal is more in the market, and the global prices are also coming down.
Okay, but FSA price increases, sir, you'll have taken up a small price increase at the end of May. We want to know whether there could be another price increase on the FSA notified prices.
There are no such plans.
Okay, no plans of another FSA price increase, at least as of now. And e-auction prices, they'll be according to the market dynamics. We got that. What about production as well as offtake? Particularly
it will be according to the market dynamics.
Yeah, go ahead, sir.
Yeah. Yeah, it will be market driven, but we are ensuring adequate availability of coal for e-auction so as to keep the general open market price also under control for different sectors of the economy.
Got it. What about the volume targets for Coal India? You know, both the production and offtake have been very impressive for the first few months. At the mid-year, it's looking quite good. What do you think Coal India produces by the end of this year, and the offtake number as well?
See, the target for Coal India is 780 million ton, and the production so far in last 5 months is 100% as per the target which we have planned for. And I am sure that in next 6.5 months also, Coal India will produce as per the target. So we are hopeful of 780 from Coal India, and total 1012 is our target. So we are aiming at 1012 million ton of the coal from different sources.
Okay, 1000 million tons by when, sir?
By March. This year's target for the country coal production is 1012 million tons. So by this year, we are hopeful to achieve this target.
Okay, all right. And out of that, Coal India will be 780 million tons approximately. Production is one factor which Coal India is keeping pace, as you said. But evacuation is the other factor. And the support of the railways has been very encouraging. Could you give us an updated number? What is the rake availability that you're getting? And what would be the ideal level that you're looking at? I'm sure it's increased over the last couple of years.
See, you know, the demand of power is going up, the production is going up, and the supply to the thermal power plant also is going up. This is happening with the additional rake availability by the Ministry of Railways. Out of the different coal companies, you know, for eastern coalfields, BCCL, CCL, NCL and WCL, there is absolutely no shortage of rakes. As per the demand placed by the coal companies, the railway rakes are being made available. For SCCL, Southeast Coalfields Limited, and MCL, at times there is more demand and the availability of rakes is little lesser. So in close coordination with the Ministry of Railway, Power and Coal, we are working out and ensuring that adequate coal is supplied to the power sector through these coalfields also. So there is significant increase in the number of the railway rakes, and that's why we are able to transport more coal. In times to come, we have monthly coal evacuation plans, rake availability plan, and in close coordination, we are working together.
You know, one problem that the stock market faces, sir, is when Coal India does well, then there could be some kind of OFS or some kind of divestment. Have you heard anything? The Coal Ministry, have you heard anything about a possible pairing off of some stake from the Government of India? Because things are looking up for Coal India.
No, there are no such plan and proposals, and I really can't comment on it. Coal India is producing and transporting coal as per the plans, and our endeavor is to ensure availability of coal not only for power but all the sectors of the economy. This year, to the non-regulated sector, coal supplies from Coal India has been up by 35%.
Okay, well, that's the word coming in from the Coal Secretary, but just wanted to get a quick word in on the market as well. Not too much happening at the moment, but the Nifty is still down about 60 odd points. The pharma space is picking up today, so that's the one in action. Divi's Lab, Dr. Reddy's, Cipla are all your top Nifty gainers, up anywhere between 2 to 2.5%. And the Nifty Pharma Index is outperforming the frontline indices. The Nifty Pharma Index is up about 1.5%. So Sun Pharma as well, by the way, add to that list, up about 0.7%. So in a way, there is some defensive color to this market today. Healthcare, pharma, hospital companies are all looking pretty good. And then you have IT companies as well. There was that Morgan Stanley note where they've raised the target prices across, most of the companies, especially Cyient, which is up almost about 3% odd. By the way, there are two listings today, the Sai Silk Kalamandir and Signature Global. Okay, both those listings happening simultaneously. So we'll just wait by for how these pan out and get the first rates on your screen as well. Okay, that's Sai Silk, by the way, up almost about, I mean, of course, momentous occasion for both those companies that they list on the exchanges. So congratulations to them. But there's Sai Silks up almost about 6% We had the management recently on our channel as well. They were very, very optimistic about the growth in this space. And if we can get Signature Global too, let's see how that one, that is having a very strong listing. It's, I think, a 15% premium that Signature Global India has listed at. That's another one. I think a couple of investors are exiting as well in Signature Global. It had a good subscription too, almost 12 times subscribed, and it's listed at a premium of around 15% or so. So those are the two listings that have happened at the moment. But there's some other changes which are happening on the NSE.
Oh, absolutely. I think the semi-annual index review by the NSE will be effective from the 29th of September, and adjustments will take place tomorrow. Vivek is here to explain the impact of this on the index. Vivek, over to you.
Well, absolutely. So what actually happens is that, it's important there as far as passive funds are concerned in terms of the funds that actually track the Nifty, all of the NSE indices. And along with the NSE indices, there has been some weight changes also that has been announced last evening as far as the CPSE ETF is concerned. Now, what we've done is we've compiled a list of the top stocks that will be impacted. Remember, like you mentioned, the effect comes from day after tomorrow, and the changes, the adjustment will happen in tomorrow's trading session, in the second half of the trading session. Most of the flow estimates that we have are from IIFL Alternative Research. So the first stock that's expected to see the maximum inflow is Trent, over $67 million. Zydus Life, this particular stock, over $21 million. But the ADV impact would be quite large over here. TVS Motors, Shriram Financial, both of these in excess of $50 million. Power Grid, PNB, as well as Carbour and Universal, these are the other stocks that will see inflows. On the other hand, stocks that will see outflows on the back of this index rejig, Page Industries stock will see outflows of over $37 million, significant ADV impact over here as well. ACC, NTPC, HDFC, AMC, as well as Nykaa, all of these stocks will see outflows in tomorrow's trading session on the back of the NSE indices rejig.
Thanks very much, Vivek, for that. By the way, the market's picked up on the downside. We have broken 19,600. We are at 19,585. So that low is gone for now. I was saying this in the morning that look, more likely than not, given the global circumstances and the way things are shaping up, perhaps we will go below, and we've kind of done that. Close, of course, is always, when you look at these levels on a technical basis, close always is more important. But for now, we are under that 19,600 level. Mitesh is with us, so then to run us through what he's making of things and what he'd like to do. Mitesh, go on. I mean, what are you seeing? Because the selling has picked up in the last 15-20 minutes of trade.
Morning, Prashant. I think, my worry is looking at the charts of Bank Nifty. It had a gap down opening, and then we have seen continuous selling. So I think it's heading towards 143,990 or even 43,700 to about 43,600 zones. So that remains negative, and that will mean that, the Nifty per se will also be under pressure. Though I'm hoping 19,550 comes into play, otherwise we are looking at 19,400 as the next level to watch. But looking at the Bank Nifty charts, there's a stronger possibility of us testing 19,400 immediately in the next couple of days. Having said that, I have one buy and one sell call. ICICI Bank is another stock, which gap down and is seeing selling. So sell here with a stop at 947 for targets of 910. And on the buying side is Jubilant Foods, which I would recommend buying above 553 with a stop at 545 for targets of 570.
Okay, thanks a lot for that. Let's do one thing. Let us take a short commercial break. On the other side, Manisha will put the focus on the commodity markets. Do stay tuned in. Well, as promised, we're going to get you an update on what's happening in the world of commodities because the Brent has been surging. Manisha Gupta is standing by. Manisha, what's the one commodity that you're tracking today?
Well, I'm looking at precious metals, Sonia. I'm looking at gold prices, to be clear, because we've seen major psychological levels break down here. So we have seen $1,900 per ounce break on the international markets there. We're trading at a 4-week lows in case of gold prices. It has been a sharp decline, and gold, as of now, is trading in the negative on a week-on-week and a month-on-month basis as well. Well, even as the crude oil prices are increasing, there are inflation concerns, but all of that safe haven buying really seems to be going in for the dollar index, which is trading around 106, which also is a 10-month high. And not just dollar index, when you look at the benchmark 10-year treasury yields, they have surged to nearly 16-year highs. So a tough chance really for gold in these kind of markets there. Also, the US Fed hawkish statements about higher interest rates for longer, and yet another 25 basis point of a rate hike anticipated in this year has been weighing in case of gold prices there. To add to that, the SPDR gold ETF benchmark also has seen more redemptions in last couple of quarters, and the holdings there have declined to the lowest since Jan 2020. The charters tell us that if the gold prices continue below $1,900 per ounce, then there is a possibility that you could be looking at the 21 August low of 1884. And then on 8th of March in this year, we saw a low of 1809 as well. So those are the next targets coming in on charts. But if 1900 holds on a day-to-day or a week-on-week basis, then the expectations are that the price that we saw on 20th of September at 1947 could well be on cards there. But the positive is that the weak gold prices have led to Indian buying come back into the markets. Also, when you look at the sovereign gold bonds, the second tranche of that for this financial year ended in the previous week. And the latest numbers from RBI show that Indians have bought sovereign gold bonds worth 6,900 crores in the previous tranche itself. So with that, the holdings that we've seen coming in sense of buying has been at around 11.7 tons. This is what the second tranche has done. And the total holdings now between sovereign gold bonds, which was launched in 2015, stand at 120 tons. So clearly, the last couple of tranches have done quite well, and the sovereign gold bond buying into the Indian markets really seems to be picking up quite strong. For now, it's going to be data watch, and it's going to be U.S. personal consumption price index that the street is looking at. I mean, this is one data that the U.S. Fed gives a lot of importance to. So the markets will keep a keen eye on what this leads to in sense of next action from the U.S. Fed.
All right, Manisha, thanks very much for that. You know, there's commodities. But by the way, markets have picked up a little bit more. I mean, we were down 80. We're down almost down in 3 digits, almost a 100-point cut. 19,568 is where the Nifty is at. So pace seems to be picking up a little bit once that 19,600 level went. We'll take a quick commercial break here. On the other side, our special segment, it's the Indianomics. Lata will get chatting with Jahangir Aziz and Louis Oganis of JP Morgan from the sidelines of the conference which is being held here in Mumbai. Stay tuned.